We begin, though, with our talk of the tape, why the market might be stronger under the surface than it seems, and whether it's time to bet on that next bounce. Let's ask Cameron Dawson, NewEdge Wealth's Chief Investment Officer, right here with us at Post 9. It's good to see you. Welcome back.
Good to see you.
I mean, technically speaking, the market has held up pretty well. The breadth from the move from the mid-October low has been pretty decent, too. Is this market better under the surface than we're giving it credit for right here and now?
Well, certainly the average stock is much better under the surface. And if we look at the source of really all of the weakness from this S&P 500 basis, it's really coming from the top end of the market, those big heavyweights in communications and tech, and those areas that are really the most expensive. And so that's the process that we're still in, is that the market still is top heavy. It still is expensive because of that top heaviness, but there's definitely signs of improvement under the surface.
You got to respect the technicals, they say, right? And I mean, do you still feel like, forget about what you think is going to happen a couple months down the road. Let's talk over the next, 20, 30 days, literally. You feel like we have a rally in the cards based on where we are now and the seasonals and, we got the Fed and the CPI next week and the, other data too?
Well, one of the most important things about seasonals is that December is usually a very strong month for the market. However, it's not nearly as strong if you went into December being weak. So that seasonality loses a little bit of oomph given the fact that we had such a weak market year to date. But then it's respect that 200-day moving average, respect the downtrend line. That still remains very much in place. Right now, we're stuck in this period of congestion right around all of these moving averages. So the break one direction or another will set the tone really for the next couple of months.
Got two sides to the yield story, obviously. Good that they're coming down or at least remaining where they are. Bad because that also sends a message about economic worries.
Yeah, the most important thing to watch is the two-year yield. If the two-year yield is rolling over hard, which it hasn't yet, it's come down some, but if it rolls over hard, that means that the bond market is very afraid of economic growth. And so if we see a break in yields, you might think, oh, that's good for stocks because of valuations. But in reality, if the bond market's sending a message, be afraid of growth, then we have to listen to that because it means there's more earnings cuts to come.
I know you expect that the Fed's going to still remain aggressive, right? You've said as much, and most people, I think, assume at this point it's going to be higher for longer. That's the, the wording of the moment. Janet Yellen, though, Treasury Secretary, former Fed chair, out a little while ago and says new apartment rents have essentially peaked and are coming down with a lag. That's good news.
It is good news. And it's good news on the inflation front. What it does is it takes some of the urgency off of the Fed from having to keep up at these 75 basis points hikes. That's why they're going to moderate to 50 basis points. But then what's priced into next year is a pivot to cuts. And it's in our view that even if you see inflation come down, as long as you have better data, better growth, you have in the employment market remaining very tight, the Fed cannot cut interest rates. They cannot cut interest rates into a full employment economy. So yes, it's great that inflation's coming down, but that doesn't necessarily give them the ability to pivot towards accommodation.
But forget about the actual cuts, which could be viewed in many corners as a negative anyway, because of what it would mean for perhaps where the economy is at that moment. So the mere fact, if the inflation picture is improving and the Fed can at least pivot to a pause, right? Pivot to the end, like stop doing anything for the time being and just wait it out and see what happens. Is that enough to give stocks a lift?
Well, we traded to nearly 18.5 times earnings just last week on an earnings number that we assume would be flat for next year, which we think is a conservative estimate for last year. So 18.5 times earnings. Given the fact that even if the Fed isn't cutting rates, they would still be keeping them around 5%. That is a very high valuation given how tight the Fed would be, how tight liquidity would be. And so we think that valuation acts as a ceiling on this market, meaning that you can't get to that 22 times earnings to get you to 5,000 on the S&P simply because you need a Fed to be accommodative to get you to 22 times.
Most of the projections that I see anyway as though they roll out for 2023 are, 4,200 is where you might be capped. That was, those were the numbers of the day from some of the notes that I saw out today. In terms of where you want to be in the market, large cap over small cap, value over growth, and you still like healthcare and energy?
Yeah, and we actually just added a little bit of an overweight to materials recently on a tactical basis. Stocks are looking a lot better on an absolute and relative basis, and you get the benefit if we see a continuation of a weaker dollar. Materials can get a boost, as well as the China reopening. Exactly.